Hello, everyone, and welcome back to Money and Banking. Today we're moving into Chapter 12, which is really kind of a theoretical overview of financial crises. We'll take a specific kind of model of the development of financial crises, and we will apply it to at least two cases in the domestic sphere, the Great Depression and the financial crisis of 2007, 2008. I will note that many of the things that we will be learning in the abstract here, of course, can be applied to crises in other countries, namely a fascinating set of crises, which I have spent a lot of time focusing on, which is financial crises in emerging markets, which often come in the form of either a sovereign debt crisis or a currency crisis. And if we have time, we'll get into that, but let's stick with the brass tacks of Chapter 12 to begin with. For our preview, we're going to note that this chapter makes use of agency theory, and we'll help to define agency theory for you. It's the theory of how agents behave in given situations, such as financial markets, that we'll be looking at. This economic analysis includes the effects of asymmetric information. So we'll talk about asymmetric information and its two consequences, which are adverse selection and moral hazard. And we'll talk about how these play out in financial markets, but the lessons there can be used in any market that we wish to apply it to or where we think it's applicable. We're going to try to see how financial crises occur and why they have such devastating effects on the economy. After this, we're going to apply our analysis to explain the course of events that led to a number of financial crises in the past, including the most recent global financial crisis and also the Great Depression. So our learning objectives are: define the term financial crises, identify key features in the three stages of financial crises, describe the causes and consequences of the financial crisis of 2007 and 2009, summarize the changes in financial regulation and that developed in response to this global financial crisis, and identify the gaps in current financial regulation, how they might be addressed with future regulatory changes. To get started, let's talk about the abstract. Let's talk about what we mean by agency problems. Well, as we said, agents are these individuals that are participating in markets or market exchanges. And so we could have some problem with the behavior or the incentive structures that's guiding those agents, which then leads to, problems in a transaction or problems in an overarching market. One of the classic agency problems that we study, and one of them that sort of plays out quite frequently in financial markets and in corporate markets and so on and so forth in economics, is the principal agent problem. The principal agent problem occurs when there are incentive problems that cause the interests of the agent to be in conflict with the interest of the principal. Okay, so who are these two entities? These are two members of an exchange or some kind of contractual arrangement. The idea here that the principal is the primary stakeholder or the owner. And the agent, who is separate from the principal, is some entity that is tasked with executing the principal goal set of our principal here, right? So you have a sort of a main character that wants to get something done. This is the principal. They have certain rights and so on and so forth. Then you have the agent, who is sort of the steward of their interests. And oftentimes we can have an issue where incentive problems cause the agent to be in conflict with that of the principal. So for a couple examples, you can think that we have lenders and borrowers, right? So the lender, they're the ones who take their money and they entrust it to a borrower. And the idea is that the borrower is supposed to pay the lender back and engage in safe behavior and, do everything they said they were going to do with the money that was borrowed. But the borrower has an incentive sort of misalignment with the lender, right? If the borrower loses the lender's money, well, the lender is out money, and the borrower, well, they just default on their loan. So, when you're thinking about this, if you're a borrower and you've said you were going to do, very safe endeavors with the money that you borrowed, and give it a go, then you're a good agent in this case. But if you just take the money down to Las Vegas and you put it on the crap table, well, maybe you could triple or quadruple your money, in which case the profit would all be yours. And so you're thinking, maybe I should take on more risk than the lender is comfortable with, because the upside belongs to me and the downside belongs to the lender, right? And so there can be a principal agent problem with borrowers and lenders, where borrowers have the incentives to take on more risk than the lenders would have wanted them to, thereby increasing risk in the system or in the transaction. You can see a similar problem with shareholders and CEOs. Who owns the company? Well, oftentimes it's not the CEO, especially if the company is a large publicly traded company. The shareholders own the company, and these shareholders could be pension funds, wealthy investors, or individuals like you and me who may own a small share of the profit in, say, Marvel or Netflix or something, right? So you have these disparate shareholders. They own the firm, but they typically don't run and manage the firm, because they have ownership of many firms across a diversified portfolio, if you will, right? If you're a pension fund or something, or an asset manager, you may be managing, portfolios of ownership in Google and Netflix and Coca-Cola. Your job is to run the portfolio, not to run the company. So the owners of the company, the shareholders, they hire CEOs. These are the agents. The shareholders are the principal, the CEO are the agents. And they say, CEO, we want you to look after our interests and maximize profit for our shareholders. The CEO may do that, or the CEO may do something in their own best interests, like try to push up their bonuses or try to conquer a lot of territory and make a name for themselves as a CEO, maybe play empire. Maybe the CEO would like to use the company as sort of a personal ATM and buy private jets and fly around the world and eat expensive dinners and rent out penthouses in Manhattan, thereby draining the company of funds, which makes the CEO's lifestyle quite nice, but robs the shareholders of profit and dividends, right? So we have a principal agent problem again, where the interests of the agent may not be aligned with those of the principal. Maybe the clearest way to think about this is to think about retail or restaurants, or maybe even like a bar, right? You have a bar owner, they own the bar, but because they own the space, they're probably not working the bar 24/7, right? They want the bar to be profitable, but they hire people to, run the bar, like a bartender. Now, the bartender, he's tasked with the idea of making profit for the bar owner. But the bartender may have a misalignment of incentives because, of course, the bartender wants to make tips. So perhaps the bartender gives away free shots of alcohol in order to ingratiate himself with the consumer, and therefore receives large tips for giving away the bar owner's liquor for free, essentially robbing the bar owner, right? So again, we have this principal agent problem, and one of the things that we want to do is we want to try to eliminate this principal agent problem. And some of the commonly put forward solutions are things like transparency and credible monitoring, as well as credible punishment, right? So if you can think about when you walk into a retail store or something and you look up at the ceiling, what you see is, these little opaque black orbs that ostensibly have cameras in them, and then those cameras are supposed to prevent people from stealing from the retail. So you'll see them above the cash registers to make sure the cash register people aren't skimming or shoplifting or what have you, right? And this is also why we have things like corporate boards, right, to try to monitor what's happening with the CEO. So the principal shareholders hire a smaller subset of overseers of the CEO that then monitor the CEO's behavior. This is supposed to be the role of a corporate board. We have lenders and borrowers, and of course there can be various covenants and oversight placed into a borrowing agreement. The idea here is that the agent needs to feel like they are being watched and that their conduct is transparent, and that if they are veering in the direction of looking after their own interests rather than that of the principal, that there would be some sort of credible punishment down the line. And so these are some of the commonly put forward solutions. Each of them oftentimes can be hard to implement and have their own problems, if you will. Information asymmetries will play an important role in our analysis of financial crises. Information asymmetry occurs when the distribution of information among market participants is not even. So in this case, one side of the market will have more relevant information than the other. An example might be that debtors, of course, know more about their ability to pay back the money than do the lenders. Banks know more about the soundness of their balance sheet than do their depositors or their clients or their bondholders. And corporations know more about their balance sheets than the shareholders do, right? So we have an asymmetry of information there. When we have an asymmetry of information, this can lead to a problem called adverse selection. Adverse selection occurs in the presence of this asymmetric information. Uneven information distorts the market incentives and leads to a situation of market failure, where essentially the market collapses or it stops functioning. In this situation, the market is selecting for the most undesirable participants. Let's look at a few simple examples. Consider the insurance market. Maybe it's car insurance, maybe it's life insurance, maybe it's health insurance, right? The idea here is that an individual buys a policy that says, they'll be covered in the event of, a fire or a car accident or what have you, or a medical emergency, and they agree to pay in, of course, premiums every month in order to guarantee that in the unlikely event that they did face some catastrophe, that the entire cost would be paid by the insurance firm and the individual wouldn't have to go bankrupt, right? So the idea here is that the insurance firm stays, liquid and stays solvent if, its premiums that are paid in by all of its, members are enough of a pool to cover the unlikely event that one of their many members has a catastrophic cost that they have to pay, right? And so the solvency and the liquidity of the insurance market depends upon that balance, right? Okay. Well, in the insurance market, it's pretty obvious that if the cost is an average cost of insurance, that very, very high-risk individuals are going to flock to buy insurance. They're the ones who need it the most. They're the ones who are most likely to use it, and for a moderate cost, they'll be thinking they'll be getting a deal, right? I'm a very high-risk person, and I'm going to be getting this insurance policy for quite cheap. Well, low-risk individuals would be wanting to steer away from average-priced insurance contracts because they'd say, well, that's a ripoff for me, right? It's very, very unlikely that I'll face a catastrophic event. Why would I pay such high premiums to do this? And as a consequence, the insurance market would select for only high-risk individuals. They'd be the only ones willing to buy premiums, and then the insurance company would have a portfolio of clients that were much more high risk than one that was distributed among risk profiles that were heterogeneous. And so it is likely then that the insurance firm will go bust or face, financial constraints as they start to select for the undesirable market participants, the very, very high-risk individuals, right? And so the market can start to fail, where insurance providers say it's not profitable to provide insurance because the only people that we can find to buy it are very, very risky individuals. So there's a lot of ways in this adverse selection and market failure can lead to these changes in markets. One of the classic examples is called the lemons problem. It's from the used car market. If you can imagine that there are two types of used cars on the market, ones that are absolutely garbage, we call them lemons, and ones that are really, really well-kept, excellent vehicles, and we'll call those cherries, right? So in the market, you have both lemons and you have cherries, and the owners of these used cars, they've been driving them. They know whether their car is garbage or whether it is a really, really nice car, right? They're very aware of this. But the buyer in the used car market has no idea whether or not the car they're looking at is a very, very high quality car, a cherry, or a very, very low quality car, a lemon. So we have asymmetric information here. Let's see how it leads to adverse selection. Well, the market can't tell differences in quality, so it's going to say pick an average price for a used car. Maybe really, really great cars should go for 10 grand and really, really bad cars should go for 5 grand. But since we can't tell the difference, we're going to look at a used car market that's about, $7,500 or something, right? So here you've got this kind of average price in the used car market, and what's going to happen? Well, individuals that should be receiving $5,000 because they're selling lemons will now receive a premium of $7,500. They're going to get an extra $2,500 because the market can't clearly see that they're selling a lemon, right? And individuals that would be trying to selling cherries in the market would be knowing that their car is worth $10,000, but would only be able to get $7,500 out of the market because, again, of this opacity with regard to quality. So sellers of lemons are getting a bonus for participating in the market, and sellers of cherries are taking a loss for participating in the market. So no one will be selling a cherry, and everyone will be selling a lemon, and the market will be failed. It will be riddled in garbage cars, right? And so this is the problem of adverse selection that comes from having asymmetric information. Now, if we're thinking about solving the problem of asymmetric information, we're thinking that, well, there needs to be more clarity and less opacity. There needs to be more information on the market. But this creates some potential solutions that also have some flaws. For instance, one of the obvious solutions would be, well, look, if the buyer and the seller, need to have similar unbiased information about the quality of the car, what can they do? I mean, the potential buyer can say, hey, this is your used car. Is it great or is it poor? And, of course, every seller has the incentive to say it's an absolute cherry. Don't worry about a thing, right? And, of course, they have the incentive to lie and misrepresent in this case, right? The buyer knows that the seller has the incentive to misrepresent the quality of the car and so can't trust any information provided by the used car seller. So the idea would be, well, look, if I can't believe what you're saying to me, let's take it to a third party, somebody who's disinterested, somebody who has an unbiased approach to this, right? They're not going to make any money either way, right? And let's get them to look at the car and assess quality. So you take the car to a mechanic and you say, can you look this over and assess the quality? Well, the question here becomes who pays the third party, right? If the seller of the car is paying the mechanic, then the mechanic has every incentive to say the car is a cherry. If the buyer of the car is paying the mechanic, then of course the mechanic has every incentive to support the buyer's interests and claim that it's a lower quality car than it actually is. So we have this dilemma about, trying to have a market for information where we pay somebody to create information creates a problem by, well, who's going to pay this third party? Who's going to incur the cost of information provision? If the seller of the car is paying the mechanic, it eats into their profits, and they'd want to raise the price of the car to cover the cost of buying the mechanic, right? If the buyer is paying the mechanic, they're going to want to negotiate the sale price of the car down by the amount of what it costs to go see the mechanic, right? And this is going to create a situation where the buyer and the seller are essentially negotiating or kind of fighting over the cost of third-party provision, right? And keeping in mind that whoever is paying the entity of the third party is likely going to get information provided in their favor. So you'll see these sort of issues arise quite a lot. One of the areas where these asymmetric information and information provision problems arise is in the field of mergers and acquisitions, right? You're selling your company. You want to convince the buyer of the company that the stock is worth far more than it may be, right? You're buying a company. You want to convince the seller of the company that they've overvalued their stock. And so then you need to go through these negotiations about whose valuation of the firm will be trusted or will be more accurate. And so some economists just do valuations of firms and then, of course, try to sell those firms to mergers and acquisitions people. Another way of thinking about this information asymmetry is that, well, if this information is valuable and if markets only work when this information is available, and if private parties can't find a way to provide this information efficiently, then maybe we should be thinking of information as a public good, something that is provided by, an entity such as the government or something, right? Where market participants are taxed, right? And then some entity uses that tax revenue to generate information that benefits both the buyer and the seller, right? Public goods, things like possibly information. Some countries consider healthcare to be a public good. All countries consider policing and firefighting and national defense to be a public good, right? Public goods, you may be familiar, they must be provided by some third entity, oftentimes the government, if the private market fails to produce the good and the good is such that it presents a net positive value to total social welfare. So it's valuable and important that the good be produced. Private markets fail to do so. Let's allow public entities to engage in this. And so that's one of the potential sort of directions for a solution to information asymmetry. We'll be using the term moral hazard in this lecture. You may know what it is, but let's try to define it for you. Moral hazard occurs when a policy that is introduced inadvertently encourages exactly the type of outcome that it was designed to discourage. So moral hazard is something that enters into, public policy discussions and policy making and rule making quite often. There's oftentimes good intent behind a new rule or a new policy, but it often is short-sighted and backfires in many ways. So I'll give you a classic example. In the 1970s, it was the case that automobiles did not necessarily have to have seat belts in them, right? Some manufacturers could put them in, other manufacturers would leave them out. It was up to the discretion of the automobile manufacturer. And if individuals felt that they wanted a seatbelt for extra safety, well, they'd buy a car from a manufacturer that had a seatbelt installed. And if they didn't really care about that because they weren't so risk averse, well, they wouldn't care, and they'd reward the company with no seatbelts. So the federal agency, the Consumer Protection Agency, eventually said, well, there's so many highway fatalities that we have to find a way to reduce highway fatalities. And one of the best ways we can reduce highway fatalities is to prevent people from flying through the windshield. So we're going to demand that if you want to sell an automobile in the United States, you must have a seatbelt in the automobile. So a uniform blanket law designed with the idea that we were going to make consumers more healthy and prolong their lives. And so the seatbelt laws went into effect, and people drove around with seatbelts being worn, and the number of highway fatalities increased dramatically, right? And so people thought, how can this be? We've made individuals safer, and now more of them are dying in highway accidents. What's the problem? Well, the problem is one of moral hazard. When you introduced the seatbelts into the cars, people would click the seatbelts into the cars, and then they would feel more safe, which allowed them in their minds to drive in a more risky fashion because now they had this safety net, right? Literally across their lap and across their chest. So they took on higher risks because of the seatbelts. They drove faster, they drove more recklessly, and that increased highway deaths. So this was a moral hazard, right? Where a policy designed to have one outcome encouraged behaviors that led to the opposite outcome or some perversion of that outcome, right? Another example that you'll see in our discussion of financial crisis would be, of course, the policy to stabilize the banking system through providing government bailouts. So you get a firm that's very, very big, it's getting shaky, its balance sheet has gone upside down, it's looking like it's going to fail and default, and that bank, when it collapses, will cause it to default on all of its loans and all of its borrowing. And so some other institution who holds the entity's liabilities as assets will see their balance sheet fail. And then, company B will default on its loans, and bank C will see its assets fail. And you'd see a domino effect where, right, one company imploding would lead to a domino effect of bankruptcy for other companies, thereby destabilizing the financial system. So the argument, of course, was we need to step in and bail out these firms before they create a widespread tsunami of financial collapse. They said, we can't let these firms fail. They're just too big and they're too intertwined in the financial system. If we allow them to collapse, all of that will ripple through the tendrils through which they are connected to other entities and cause a systematic collapse of banking. So they're too big to fail. Let's stabilize the banking system by bailing them out. Which sounds well and good, of course, right? It's a short-term solution. You stabilize the banking system, right? But the problem is there's a moral hazard involved, right? If a bank is insured to receive a bailout only if it is too large and too integrated into the economy to fail, then a strategy for a bank that wants to take on a lot of risk is to, of course, become too big to fail. And so bailing out the banking system leads to the moral hazard that banks will try to become larger and more concentrated, leading to an increase in concentration in the banking sectors rather than a decrease of it. So you start to see banking systems saturated with firms that are strategically too big to fail. And thus, the system is more likely to suffer a destabilizing force in the future. Now that we've got our general concepts behind us, we can start defining what is a financial crisis. A financial crisis occurs when there is a particularly large disruption in the information flows in financial markets, with the result that financial frictions increase sharply and financial markets stop functioning. A loss of provision of information leading to frictions that lead to a really seizing up of the lending and borrowing, buying and selling that keeps financial markets fluid. There are dynamics of financial crises. These things tend to spiral, if you will, in a vicious cycle until there are significant problems. Stage one of our financial crisis might be the initiation of the financial crisis, some sort of trigger for it. This could come in the form of either a credit boom and bust, tremendous amount of lending, and then, of course, a collapse of lending or a widespread defaults and bankruptcies, essentially creating overuse of credit and flooding the market with credit into worthless assets or worthless unproductive endeavors or questionable or spurious sort of asset accumulation. This is quite common, especially in emerging markets. We could also see asset price boom and busts, right? So maybe not fueled by credit, but oftentimes related to being fueled by credit. We can see mismanagement of financial liberalization or financial innovation. Financial liberalization is when you're deregulating financial markets, you're allowing activities to take place that might not have otherwise taken place. These create profit opportunities and might lead to a tremendous amount of exuberance or overbuying or over-leveraging in these new liberalized areas, such as repressed financial countries or refreshed financial opportunities or financial sectors. We can also see asset price booms from very, very loose monetary policy, very, very low interest rates that are left too low too long, as we saw in the run-up to the dot-com bubble of 2000, 2001, and arguably before the great financial crisis of 2007. Also, there's an argument to be made that very loose or liberal monetary policy played an integral role in the Great Depression as well. Another dimension is, of course, financial innovation, when we create a new financial instrument or a new financial product, something that we haven't seen before, that we don't have a lot of track record for in terms of, how well is it going to perform. And we get a lot of excitement about this innovation, and it leads to kind of an asset price boom in that area, which then becomes a bust once we realize that the asset maybe was not quite as safe or as wonderful as we had been promised. We can also see situations where a general increase in uncertainty, which would lead to a trigger of a financial crisis. You were very, very sure about your valuations. You were very, very sure about the economy be strong in the future, and all of a sudden things become much more uncertain. You realize you were wrong, and it leads to a sell-off of stock or a sell-off of corporate bonds or the like. Stage two of the financial crisis is once you see these asset price collapses or these credit booms leading into default booms, or an increase in uncertainty about maybe the balance sheet of the participants in the market, we start to see banking crises, right? Problems with the banks in terms of their asset values collapsing, their revenue streams collapsing, and so on and so forth, these balance sheet effects. These can extend, of course, to the private sector, to corporations and the like, right? And so we can see these crises occur not only in banking, but in terms of, corporate bankruptcy and so on and so forth. Stage 3 is, of course, debt deflation, when you have to go through a write-off of all of these bad debts, essentially adjusting the balance sheet in a downward direction and leading to, if not a collapse of the firm, at least a contraction of its ability to lend or stay liquid in financial markets. This figure from your book attempts to sort of diagram these 3 stages. At every part of the stage, we see some sort of trigger, right? Either asset price declines or credit busts, leading to asymmetric information. We don't know, what the value of these firms is, how much they've lost in the credit crunch, how much their assets have gone down, leading to asymmetric information. So firms are trying to borrow money. You don't know if it's because they're bankrupt or because they have a productive endeavor going on. It leads to problems in the banking sector because any balance sheet effects on the part of borrowers will be transferred to balance sheet effects within the banking system itself as defaults become unperforming assets on the bank's balance sheet. We then have a problem with asymmetric information in the banking sector because clients and depositors and bondholders don't know whether or not the asset side of the banking balance sheet has been rocked by asset price declines and defaults among its borrowers, or whether or not it has stayed solvent and taken on an adequate amount of risk. And so this leads depositors and bondholders looking at the banking system as a questionable sort of institution in which to keep their money in, which may lead to banking crises such as runs on banks. We'll talk a little bit about those with respect to the Great Depression, but if you have your money deposited in a bank and you are unsure whether or not that bank has lost a lot of its assets through defaults or asset price declines, you might want to withdraw your funds from that bank. And if every individual wants to do so in the same manner, then the bank has no money for which it can produce assets. It essentially becomes illiquid and potentially insolvent, right? As banking crises causes the aspect of borrowing and lending to seize up in the economy, corporations have a hard time borrowing to make payroll, et cetera, et cetera, et cetera, and you start to see real economic activity decline, and this is when you see the problem move from a sort of Wall Street financial asset price markdown to a Main Street reduction of investment, economic activity, and increase in unemployment.